Welcome to the Cliffwater Direct Lending Index quarterly webinar for 2Q24. My name is Fran Byers. I'm head of capital markets at Cliffwater, and I'm joined today by Steve Nesbitt, CEO and CIO at Cliffwater and creator of the Cliffwater Direct Lending Index. Cliffwater is an alternative investment advisor. We were founded in 2004, and we're active across the alternatives investment spectrum. We currently advise on or manage $112 billion in alternative assets. Steve's going to kick things off and introduce a couple of new indices that Cliffwater has created at the request of many asset owners that use the CDLI as their private credit benchmark of choice. And he'll also provide some insights into our 2Q24 index results. I will then follow with an outlook for the direct lending market as we head into the last leg of 2024. And with that, Steve, please take us away.
Thanks, Fran. So on this first slide, we show our index inventory, if you will. Our flagship index, the CDLI, basically is the broadest index of performance for middle market direct loans in the U.S. The second two indices, the CDLI S for senior and the CDLI V for venture-backed, are subsets of the CDLI. And again, these are indices that measure the performance of the underlying private loan collateral. So they're gross of fees with no leverage. The three indices at the bottom of this table reflect after fee performance with and without leverage. Last quarter, we introduced the CDLI perpetual index, which really, this index really is growing very fast with the growth of perpetual BDCs. So we show the actual performance of these, collective performance of these perpetual BDCs. Again, inclusive of their leverage and net of fees. Our two new indices being introduced this quarter is the CDLI-U for unlevered -NOF for net of fees. We've had a number of our subscribers ask us if you could take the CDLI index and calculate what the performance is net of fees. So this index does that. We go back to Q3 2013. And if you really want to get a good flavor of the use of this index, I'd refer you to the paper we just released that should be on our website, the Go Private, Not Public Credit paper that really describes why we selected that start date and also shows the performance of public credit vis-a-vis private credit using this CDLI-U-NOF index. And then finally, we're introducing the CDLI-L, again for levered -NOF. So this is basically an index which shows the performance of BDCs over time. So if I'm investing in private funds, if you will, and I want to compare performance against a benchmark, this is a really good benchmark to do so. And that will also be on our website for subscribers in the next day or two. We're just finalizing that. So with that, let me turn to the CDLI and give you some general comments on what we see going on. And it's basically steady as you go. So the marketplace, if you look over the trailing 4 quarters, the total return for the index is 12.3%. Basically, pretty consistent performance over those last 4 quarters. Realized gains at or losses, net losses of 66 basis points. kind of offsetting slightly a very strong interest income of 12.31%. There have been some unrealized gains of 65 basis points. So basically, over these last 4 quarters and extending a little bit further, basically this index on a net basis has earned its yield. Over longer periods of time, let's go from inception in September 2004. Again, the interest income at 10.85%. It's been higher more recently because of higher reference rates, but double-digit interest income, realized losses of 1.02%. I've already said that the marketplace realized losses from defaults have averaged about 1%. And net unrealized gains or losses, basically that they generally average about or approach 0% over this inception period. It's been minus 24 basis points. I like this graph at the bottom of this slide. For many of you, this represents a very attractive carry trade, where you clip coupons steadily over time, and infrequently, depending on adverse market events, you may see some losses. Most of those losses attributable to are unrealized, which are reversed shortly after. But this basically represents a very attractive return stream that most people want to include in their portfolio. And on this topic of unrealized versus realized, I've shown this graph in the past, updated it for the current quarter. But basically, unrealized losses are generally quickly realized in subsequent quarters, or they're reversed. So if we start with the financial crisis, at first we saw significant unrealized losses, markdowns in the portfolio. Okay, those unrealized losses are reversed 2010, 2011, and basically are replaced with realized losses. So also during the oil crisis and COVID and Russia, basically realized credit losses are preceded by unrealized credit losses. And then those unrealized are reversed when they're realized. I like this graph because it basically shows it addresses concerns about valuation of loans. This demonstrates that that prices or marks on loans are fully reflected, more so reflected, and that they actually are conservative, that actual realized losses are less than unrealized losses. So we feel very good about our return stream, that it fully reflects market conditions, and valuation is, we're very happy with these independent valuations we have on these loans. Quick, some dashboard things that I think are relevant for the most recent quarter. First is effective life. You know, we had been in a situation where depressed M&A market. There was some amend and extend. If you look at this blue line, this is the effective life of the loans in the index. It had grown significantly. Generally, it averages a little less than 3 years. It had grown significantly to over 5 years about a year ago. It is rapidly coming down, currently at 4.33 years. With the expected pickup in M&A activity that Fran will talk about, we expect that to fall further in the quarters ahead. Also, non-accruals, again, mostly good news. The non-accrual rate is shown as a percent of cost in that dark shaded area. Right now, that stands at 1.6%. You read that off the left axis. That's down significantly. That is well below the 2.2% historical average. So that's good news. It's been bumping up and down. It did tick up, but last quarter it was 1.4%. If you look at the recovery rate from on the line in the right-hand axis, pretty consistent at about 50% recovery rate. So all in all, if you actually look at actual problems measured by non-accruals or actual realized losses, basically it's been uneventful this quarter, as it's been really over the last 6 quarters or so. The only concern, and we've seen this in the press recently, is PIK, payment in kind. PIK occurs either for two reasons. In the loan origination, there may be an option given to the borrower to pick some of the income. So they may choose, within the covenants to pick as they see fit, and that can occur. That doesn't represent a problem. That's their option. The other source of PIK is when it's a special default, maybe non-cash default, and the lender agrees to defer some of the cash interest and turn it into PIK. That's more of a concern, and so basically we want to watch that and monitor that for the universe of loans reflected in the CDLI. All that said, it did tick up pretty significantly for the quarter, from 7.3 to 8.4%, probably reflecting continued strain from high reference rates. So we'll have to monitor that closely in the quarters ahead. So with that, let me turn it over to Fran to give you a more detailed outlook on what's going on in the marketplace.
Great, thank you, Steve. If you flip to the first slide here, we can address one of the biggest topics that has been on everyone's minds in 2024, and that is, when will new money supply sufficiently pick up to soak up the capital that has come into the direct lending space? So the deal flow question is a very interesting one, because depending on which private credit manager you talk to, or perhaps you're dialing into earnings calls for BDCs, you're hearing very mixed reviews on the deal landscape. Some managers have touted very solid deal flow as of late and reported really strong origination figures for 2Q24, while other lenders have been signaling that the competitive landscape is very fierce and new money supply has been insufficient to soak up demand. So which manager is right? Well, they both are, and I'm going to highlight why. So on this slide, we show you overall volume stats across the direct lending market. I rely heavily on KBRA's DLD's data. They do a really good job of cutting through the noise as they focus solely on collecting data in the direct lending market. And if you look at the annual volume chart here on the right, what you see is that in the first 3 quarters of 2024, we are at very high record levels of volume. So indeed, direct lenders have been incredibly busy this year. But upon closer look, the green bar is basically refinancings and repricings, which doesn't provide lenders an opportunity to put new money dollars out the door. It simply cuts the yields in their portfolio one borrower at a time, as lenders have to decide whether they're going to roll their exposure or exit those borrowers' deals. So early in the year through today, most lenders have been making the decision to stay in these credits and support their high quality borrowers. But now, as the year has progressed and rates have come down, average or below average borrowers are also coming back to the market, trying to shave spreads down. You are starting to see lenders try to hold the line on price And sometimes some folks are starting to exit some of these credits because pricing is getting to a floor. And so after having new money lending drive 80 to 90% of lenders' focus and time between the years 2021 and the first half of 23, new money lending has only really accounted for about 50% of volume this year. In fact, if you look at the chart on the left, we can see the sheer volume of refinancings and repricings, which have been going for 4 straight quarters now since the fourth quarter of 2023. Typically, when we analyze repricing waves in the past, you see these waves last anywhere from 1 to 2 quarters. It's really hard to recall a repricing wave that's lasted for 4 straight quarters, which is what we've been experiencing all year and still today. But there's 2 primary ways a repricing wave ends. The first is either we have volatility return to the market, which can cause fear, outflows, and a repricing of risk, or new money supply picks up and creates a supply-demand balance. The good news is that we are starting to see signs of new money lending accelerating in recent weeks. In fact, if you look here, the new money lending in July was the highest monthly volume we've seen since the second half of 2023. And while August tends to be a light quarter or month, due to the usual summer slowdown, most lenders you talk to are optimistic that with spreads coming tighter, M&A volume is starting to show a solid pickup. And so the fourth quarter of the year should be the best quarter of the year for lenders to put money out the door and to deploy. Moving to the next slide, we can discuss the trend of mega deals. So mega deals are really critical to creating balance in the market. So looking here to the chart on the left, we can see the sheer volume of mega unis over the past few years, which is defined as $1 billion plus first lien financing within the direct lending market. 2021 and 2022 produced about 40 to 50 billion in new money mega deals each year, which really helped the big asset managers, who are also the most successful fundraisers, move up market and find a home for their inflows. But unfortunately, as you can see in 2023, we saw new money mega deals slowed by 60%. And again, new money is defined as M&A financings, basically. And while in 2024, we're seeing much improved activity because the first 7 months of 2024 is really only about 10% behind full year 2013 levels, it's still been too light to absorb the inflows that we've seen over the last 12 to 24 months. Although volume is certainly poised to improve this year as the last quarter approaches. But to date, what you'll see here in these green bars is that mega deals have actually been a huge driver of the massive amount of refinancings in the past 9 months, because these large scale borrowers can easily get a public rating, go back to the institutional market and obtain cheaper financing. And so for the large scale direct lenders that have been fundraising, which you can see here has been very robust in the chart on the right, it's been hard for those big asset managers to maintain yield and to find enough places to attractively deploy this year. And if you dialed into a lot of the bigger asset manager earning calls, you heard them say the upper part of the market has been somewhat less attractive this year compared to prior years. And so many have started to actually move back down market, which is deepening the intensity of the competitive landscape. But the good news is we just saw 3 mega LBO uni financings hit the market in July. That's decent. So it does appear that activity is poised to pick up post Labor Day. So flipping to the next slide, we can see the effect on yields across the index and across the new issue market. In the chart on the left, we track the yield within the portfolios of managers in the CDLI index. It has fallen for 3 straight quarters through 2Q24, but it's still at 11% area, which is still a very nice yield. We do expect that when the 3Q24 data comes out, you're going to still see a tightening trend in that data. Meanwhile, on the right-hand side of the chart here, this illustrates new issue first lien loans that we track. And we've seen 5 quarters of consecutive tightening across the market through 3Q24. The tightening has been happening in both spreads as well as upfront fees, as base rates have remained still quite high at over 5%. Lenders have been accepting of these pricing declines because, number one, yields are still really attractive. An 11% return on an unlevered basis on a first lien loan is still very, very attractive. And in analyzing the August data so far, it does appear that spreads and upfront fee tightening has hit a floor. In fact, August spreads are 6 basis points higher than the lows that we saw in July. So that's a good sign that the tightening is starting to dissipate. And we are starting to see lenders push back on these repricings and spread tightening, especially now that rate cuts are very likely on the horizon. So flipping to the next slide, where can managers go to find incremental yield? In the chart on the left, we can process how much spreads have come down across the EBITDA size spectrum to the low 500 basis point area on first lien loans. So we break this up into 4 buckets, kind of lower middle market, middle, and upper. With a thin supply of mega deals in that greater than $100 million EBITDA category, we've seen material tightening of 70 basis points since the beginning of the year. Many of the larger lenders have been venturing down into the $40 to $100 million EBITDA segment to find an additional boost for deployment. And that's driving pricing down materially in that part of the market. So that $40 to $100 million range seems to be the most competitive part of the market. Since so many lenders can play there, almost everyone's hold size qualifies them to compete there. And this is even more true because sponsors typically like to club up their deals among multiple lenders in that part of the market. And so this is where we are seeing allocations get cut back the most in the recent quarters. The sub 40 million of EBITDA segment has also tightened, but it's held up slightly better from a risk-adjusted return standpoint relative to the bigger borrowers. You see a lot more sole lender deals in that lower end of the market. And some of the big asset managers really don't have the time to play there because it doesn't help them deploy sufficiently because the deal sizes are just too small. So it's a bit easier to maintain pricing and structural discipline at the lower part of the market this year. For those lenders that do want some extra alpha in their spread, focusing on ARR lending or non-sponsored lending can certainly get you a premium. Although those market segments have followed a very similar pattern of tightening, but managers can earn an additional 50 to 100 basis points of spread premium if they're willing to go up the risk spectrum in those parts of the market. Flipping to the next slide, we can switch gears away from the new issue market and talk a little bit about portfolio health, which Steve touched on a little bit earlier. Volatility has resurfaced and crept into the broader public markets this summer. It's mixed, right? Mixed data has been coming out on earnings, and some folks are questioning where is the economy headed. It seems that the news cycle week to week has been changing pretty wildly. Within the direct lending market, although portfolio health is still much better than what it was historically, we did see some signs of cracks surface in the 2Q24 data, as you can see in the chart on the left. So Steve showed you non-accrual rates on the outstanding loans. This chart here shows you just LTM default rate. So new loans that are put on non-accrual through the second quarter. And what we've seen here is that after being flat at 1.5% default rate for the past 4 quarters, which is very benign, we did see a jump to 1.9% in 2Q24. Now, a big factor causing the default rate spike is the Pluralsight deal, which has been well covered by the media. It represents close to $1 billion of loans within the CDLI. And you can see in here on the chart on the right that the technology sector, its default rate jumped. It went from 90 basis points last quarter to 2.5% in 2Q24. Healthcare is also showing new names going on non-accrual status. And those are 2 of the biggest sectors within the CDLI. Now, Pluralsight is a very large ARR deal. Typically, large-scale mega unis have been pretty resilient to date. We haven't seen many mega deals go on non-accrual status at all. So this is an example of how when a large-scale financing does go sideways, it will move the index and the default stats. Pluralsight's the largest non-accrual we've seen in the index back 20 years. It is a widely held name across many large-scale asset managers, and it did move the non-accrual rate up for quite a few managers this quarter. Now, while Pluralsight was a big contributor to the uptick, new loans placed on non-accrual status was noticeably higher this quarter when we did a simple count. We tracked about 141 new names placed on non-accrual status this quarter. That's up from 93 names last quarter. But again, the CDLI universe is large. There's like 8,000 obligors in the universe. So the credit issues are still just in the tail of the portfolio. It's not widespread. And of the top 5 biggest defaults this past quarter, 4 were tech names and 1 was a healthcare name. So tech has always been such a resilient sector in the past. But it's also been a very prolific sector to lend to within the direct lending universe. It drives 25% of the index today versus only being 10% of the index 10 years ago. So we should expect to see more tech names over time struggle, because not every tech name is going to be a winner, and it's prolific. So yes, it's a recession resilient sector, but the competitive landscape in tech can also change very rapidly. This slow degradation in the default rate was expected. We've been highlighting, and Steve showed it earlier, that we're well below the long-term average of 2 to 2.5%. So it was expected that we were going to see an uptick based on where base rates are. That being said, with spreads tightening and base rates likely to fall over the intermediate term, it should alleviate some of the cash flow pressure that borrowers have been facing. Now, moving to my last slide here, just want to highlight a few key points this quarter on losses and future losses within direct lending. As Steve highlighted earlier, we have a few sub-indices within CDLI. The All Senior Index, CDLIS, which tracks performance of first lien and unitranche loans. The Venture Index can analyze performance across venture lending. And then the Perpetual Evergreen Index, which has a shorter track record at 2021 inception date. As you might expect, venture lending is still, from a credit standpoint, the worst performer within our index. Losses have been material. It's also a very small index, so it's concentrated. But the jump in unrealized losses you see here in the chart on the right, on the left, signals to us that there is more pain coming in venture lending. Meanwhile, managers with portfolios of 90 to 95% first lien loans are showing much better credit health versus the overall index. But what's very interesting is if you look at the newly launched perpetual vehicles in the CDLIP, they're not showing any signs of unrealized or realized losses in the second quarter. So this highlights that newer managers do benefit from having younger portfolios, as most credit issues, they really start to surface 2 to 3 years into the life of the loan. But this lack of unrealized losses in the CDLIP also means that third-party valuation firms didn't really move marks very materially in the second quarter due to spreads changing. And that most of the unrealized markdowns that we saw for managers this quarter were likely credit issues and future credit issues that might be potentially coming, not valuation issues. The chart on the right does highlight managers' risk ratings within the index. So we go through every name in the index. These managers will tell us where they risk rate their assets. The watch list is risk rating 3 and 4. It continues to be about 9 to 10% of managers' book, which is stable. It's been there for the last 8 to 9 quarters in that area. So again, if we went back to COVID, when we had a huge market-wide dislocation, it was more like 25%. So again, doesn't look like managers are projecting any sort of material change in credit health. That concludes our presentation for the quarter, hoping that you found some of this information helpful. As a reminder, if you want to be a subscriber to our CDLI data, please reach out to us on cliffwater.com and we can help you get access. We offer a lot of cool analytics and research beyond what you see here today, and we continue to build out the offering with the goal of helping investors analyze performance in this market. And with that, I'll turn the presentation back over to Steve.
Thanks, everybody, for joining us today. Again, our website should be fully updated by the end of this week. Please enjoy the rest of your summer, and we'll talk to you in 3 months.